I'm Michelle Makori, and we're at the NASDAQ market site in the heart of New York's Times Square. The Fed has so far penciled in 2 rate hikes in 2019. But Chairman Jerome Powell has indicated that the central bank is ready to change course significantly if necessary. So what can we expect from the Fed, and what could that mean for the private credit sector? Joining me to discuss is Coleman, co-founding partner of Bain Capital and the Chief Investment Officer and CEO of Private Credit Specialists, RMWC. Coleman, great to have you with us.
Good to be with you again, Michelle.
Coleman, we were hearing from former Fed Chairman Janet Yellen that the Fed may have in fact implemented its last hike for the cycle. She says that if the global economic slowdown spills over into the U.S., this may be it for this cycle. We know we have a Fed meeting January 30th. What are your expectations?
Interesting that we have the former Fed chair giving hints to the current Fed chair. We have to remember that this is really uncharted terrain. The experiment in zero interest rate policy and quantitative easing of various sorts had never really been attempted before. So there are things we know and things that are unknown. And there's a whole industry of Fed prognosticators. Will there be 1 or 2 or 3 increases? Will it be 25 basis points or 50? Our view is a bit broader than that. We're more interested in what's the range of outcomes that might occur, and how do we protect capital first and foremost across that whole range and generate gains in most of those circumstances.
Well, we are in a range of circumstances. As we said, we now may or may not be in a rising interest rate environment. So why does it make sense to be in the private credit sector in the first place right now?
Well, I think private credit opens up possibilities for how you deploy capital that if you're restricted to the public markets, you don't have available to you. For example, you can set interest rate duration much shorter so you can deal with rising rates and deal with volatility more effectively. If you're prepared to take some illiquidity with your capital, the spreads between private versus traded credit are quite broad and quite appealing. For example, coupons in the 10 or 10.5 or 11% range for well underwritten, first lien, heavily collateralized credit. That type of proposition on risk and return is just generally not available now in the public markets.
Now, in terms of your strategy, we are, as you say, in unprecedented times, and so much so that Mohammed Al-Arian, in a recent Bloomberg article, says that some of the expectations are for a pause this year and potentially a cut over the next 2 years. What does that mean for your strategy then?
One has to be prepared to deal with that full range, which makes investing that much more complicated now than it has been in other times. But we started thinking about these types of circumstances back in 2011 and really tried to map out what could happen. What are the risks? What are the distortions associated with the new Fed policies? And what are the types of opportunities that are available that might not have been available before? Mohammed's a thoughtful guy. He may well be right. Just 90, 120 days ago, the market, or the consensus was several increases over the course of 19. Again, we step back and ask ourselves, how will the credit positions that we are underwriting and investing in, how will they behave under those different circumstances, and shock them against sort of the outlier circumstances as possibilities? Because at the end of the day, no one can predict with great precision where we're headed.
But you have had a range of experience in various unpredictable terrain through various market cycles and through various market surprises. In terms of RMWC, though, that was funded in 2011. You went through the taper tantrum of 2013,
right.
And also the bond bust of October 2016. How did the strategy perform through that?
We've been fortunate to have 3 significant test runs of our strategy. The first was the taper tantrum. We had a modest decline of about 80 bips and recovered it within 5 weeks, whereas the broader indices, it took over a year to recover. So that was test number 1. Then the bond declines in the fall of 2016, and then more recently, the last 3 or 4 months, where there's been significant volatility that had not accompanied much of this cycle. In all of those, we've either been able to hold on to gains that we'd developed or expanded them to some degree. 2018 was a very, very difficult year across a range of equity and credit markets. For us, focused on our private credit specialties, it was a record year. It was the best year we have ever had, which really underscores being prepared for the risks of this kind of market.
Yeah, a record year in 2018. It certainly does. Thank you so much, Coleman Andrews. Great to have you with us.
Thanks.